Welcome back to the Deep Dive. Today we're tackling a really interesting structure, the Luxembourg Société d'Investissement en Capital à Risque. That's a mouthful. Let's just call it the SICAR.
Right, the SICAR. It sounds incredibly formal, but its purpose is surprisingly direct. And if you're listening, our mission today is, well, to get you quickly up to speed on this thing.
Yeah, understand how this vehicle, set up back in 2004, manages this neat trick of being super flexible for PE and VC investors.
But also, crucially, staying fully regulated and supervised.
Exactly. It's aimed squarely at sophisticated players. How does it manage that balance? Being flexible for risk takers, but also operating under the constant watch of the CSSF, Luxembourg's regulator.
That's the core puzzle. Let's unpack it.
Okay, so first off, what is its main job?
Well, fundamentally, a SICAR is an investment company, but it's laser-focused. It invests only in risk-bearing assets.
So think private equity, venture capital.
Precisely. Maybe some specific types of indirect real estate deals too, but the key ingredient always has to be risk capital. That's its mandate.
And this all comes from that 2004 SICAR law, mostly. Though I see it got updated by the AIFM law in 2013.
That's right. The AIFM law integrated it into the wider EU framework, but the core mission hasn't really changed. It's still about risk capital.
Let's pin down that term, risk capital. What does the regulator actually mean by that?
It's quite specific. The CSSF looks for assets that represent direct or indirect investments aimed at getting businesses launched, helping them grow, or, taking them public eventually.
So it's not just about passively holding assets. The regulator is looking for that active element of backing development or expansion.
Exactly. They evaluate it case by case based on their practice. Does the strategy genuinely involve risk tied to a company's operational life cycle? That's the question they ask.
Okay, that defines what it invests in. Now, who gets to invest? I heard it's quite restrictive.
Oh, absolutely. Very strict gatekeeping here. SICARs are only available to what the law calls well-informed investors.
Right, so definitely not a retail product.
Yeah.
We're talking institutional money, professional investors.
Or individuals, potentially. But they have to meet pretty high statutory thresholds for wealth, experience, or minimum investment size. It's designed to keep it within the sophisticated sphere.
And that restriction, that's kind of the key that unlocks the flexibility, isn't it?
It really is. Because once you limit the investor base, you get this. The SICAR has no legal requirement to diversify its investments.
Wow, okay. That's huge in the PE/VC world.
Isn't it? Think about it. Many big successes in PE or VC come from concentrating capital in just a few key bets.
Yeah, you might have one or two portfolio companies that really drive returns.
And the SICAR structure allows for that. You can have a really focused deal-by-deal approach as long as your own fund, documents, the prospectus permit it, no diversification rules imposed by law.
That's a major advantage. But it can't be that easy. Is there a catch? Like minimum size?
There is. You need a minimum subscribed share capital of 1 million euros.
€1 million, okay.
And you have to reach that within 12 months of getting authorized by the CSSF.
1 million. That's quite a hurdle, especially maybe for smaller first-time venture funds. Does that sort of filter out the lower end of the market?
It probably does, yes. It acts as a filter. The idea is likely to ensure that SICARs are used for substantial, properly capitalized ventures that can actually handle the regulatory overhead. It signals seriousness.
Fair enough. So once you're over that 1 meter hurdle, what about the actual legal structure? Is it flexible there too?
Very flexible. You can choose from 6 different legal forms. Things like the standard public limited company, the SA, or the private limited liability company, the SARL.
Okay, the common corporate forms.
Right. But also various partnership structures. You've got the SCS, which is a limited partnership, or even the SCSp, the special limited partnership, or variations with variable capital like the SCA.
So why so many options? Is it mostly about tax or liability for the partners?
Often it's driven by the investor's needs, particularly their tax domicile. Some investors prefer flow-through partnership structures for tax neutrality in their home country. Others might prioritize limited liability through a corporate form. It lets you tailor it.
Got it. And I saw something about compartments. Can you split the fund up internally?
Yes, if you write it into the prospectus from the start, you can set up segregated compartments.
Like mini funds within the main fund?
Kind of. Think of them as firewalled sections. Each compartment can have its own investment policy, its own assets, its own liabilities, and crucially, they're legally separate. If one compartment hits trouble, it doesn't take the others down with it.
That sounds useful for multi-strategy funds. Okay, let's switch gears to supervision. We said it's flexible, but it is regulated.
Absolutely crystal clear on this. The SICAR is a regulated vehicle. It needs CSSF authorization to even exist, and it's under their ongoing supervision. No shortcuts there.
So what does that supervision actually involve? What do they have to report?
Well, the reporting reflects the kind of assets they hold, long-term, illiquid stuff. So a detailed prospectus is mandatory upfront. Then you need an annual report, and that has to be audited by an independent auditor.
Okay, annual report and audit. What's not required?
This is where the pragmatism comes in. Because it's PEVC, the law doesn't force things like frequent net asset value calculations, NAVs, or having a fixed policy for investors to redeem their shares. And no semi-annual reports either.
That makes sense for illiquid strategies. Cuts down on the operational drag.
Exactly. But you still need the core infrastructure in Luxembourg. An independent auditor is a must. You need central administration and registrar services based there. And depending on the legal form, a depositary bank.
And the big one, you need an AIFM, right? An alternative investment fund manager.
Yes, absolutely critical under the AIFM directive. Depending on how much you manage, you'll need either a fully authorized AIFM or, for smaller amounts, potentially a registered AIFM.
And that AIFM isn't just for compliance, is it? It connects to marketing the fund.
Ah, you've hit the nail on the head. That's the key linkage. You spend all this effort setting up a regulated SICAR.
But the SICAR itself doesn't automatically get a passport to be sold across the EU.
Correct. There is no product passport for the SICAR vehicle itself. Just because it's CSSF approved doesn't mean you can freely market it everywhere in Europe.
So how do you market it then?
It comes down to the manager, the AIFM. If your SICAR is managed by a fully authorized EU AIFM, that manager can use their AIFMD manager passport to market the SICAR to professional investors in other EU countries after following the notification procedures.
I see. So it's the manager's passport, not the fund's passport, that opens the door across Europe. That's a really important distinction.
A crucial one for anyone planning distribution.
Okay, let's get to what often drives these choices. The tax regime. I read something fascinating. SICARs are often called fully taxable entities, which normally sounds like bad news for a fund structure.
Right. It sounds counterintuitive, but it's actually, well, quite clever. Yes, technically, a SICAR in corporate form is subject to Luxembourg's standard corporate income tax, currently around 24.94%, give or take.
Ouch. But,
and this is the massive but, any income the SICAR receives from its securities, so dividends, interest, whatever, and any income from selling those securities' capital gains is fully exempt from that corporate income tax.
wait, so the main money it makes, the profits from its actual risk capital investments, is tax-free inside the fund?
Exactly. The income derived from doing what the SICAR is designed to do is exempt. It neutralizes the corporate tax on the core activity.
That's quite an exemption. What else?
It gets better. SICARs are also exempt from Luxembourg's net wealth tax. There's no annual subscription tax, which applies to many other fund types. And generally speaking, when the SICAR pays out dividends or interest to its investors, there's no Luxembourg withholding tax.
So it's taxable on paper, but the actual risk capital activity generates tax-exempt income. And there are other tax breaks too. Why bother being taxable at all then?
Ah, that's the strategic genius part. It's about treaty access.
Because it looks like a regular taxable company on paper.
Precisely. Because Luxembourg considers it a fully taxable resident company, the SICAR can generally benefit from Luxembourg's huge network of double tax treaties with countries all over the world.
Ah, so that makes it much cleaner and more tax efficient when the SICAR invests into companies in other countries or receives income from them.
Exactly. It avoids tax friction internationally. It can also often benefit from things like the EU Parent Subsidiary Directive. Taking that fully taxable status is the price of admission for treaty benefits.
That is clever, deliberate financial engineering. Okay, so given all of this, the regulation, the tax-specific setting one up must be quite a process. Walk us through the typical steps.
It's definitely structured, mainly because you need that CSSF green light. First, you nail down your investment strategy and pick the best legal form, like we discussed.
SARL, partnership.
Right. Then you have to appoint your key Luxembourg service providers, the AIFM, the depositary, the administrator, the auditor. Get them lined up.
Then draft all the paperwork, prospectus, articles.
Yeah, especially the prospectus, detailing that risk capital policy very clearly. Once all that's ready, you submit the whole package to the CSSF for authorization.
And you can't do anything until they approve.
Nothing involving investors. Only after you get the CSSF authorization can you actually have the first closing, admit your investors, making sure you rigorously check they meet the well-informed criteria, and do all the AML CFT checks.
Anti-money laundering, counter-terrorist financing, standard stuff, but important.
Very. Then finally, you can call capital from those investors and start making investments according to your strategy.
Makes sense. Are there any sort of newer wrinkles or modern things to consider? I saw mentions of virtual assets and some tax rule changes.
Good points. On virtual assets, yes, it is now potentially possible for a SICAR to invest in them. However, it's got to fit the risk capital definition, which might be tricky depending on the specific asset.
And the CSSF is likely watching crypto very closely on the AML side.
Extremely closely. You'd need very robust AML-CFT procedures specific to virtual assets. The bar is high.
And the other point was about reverse hybrid rules. Sounds technical.
It is a bit technical, yes. It relates to EU rules preventing certain tax mismatches. Luxembourg clarified in 2025 how its collective investment vehicles CIV exemption applies. For a SICAR, whether these rules bite depends a lot on its legal form partnership versus corporate and the tax status of its investors.
So the takeaway is, get specialist tax advice if you have international corporate investors.
Absolutely essential. It needs careful analysis for any new setup today.
Okay, so let's try to wrap this up. What's the essence of the SICAR?
I think it's that unique blend. You've got serious regulatory oversight from the CSSF, which gives it legitimacy.
But combined with really significant structural flexibility, choosing your legal form, no forced diversification, using compartments.
Exactly. And then layered on top is that powerful tax efficiency, specifically the exemption for the core income and gains from the risk capital investments.
So for you, the listener, if you're involved in high-level PE or VC, it offers this consolidated, regulated route that doesn't tie your hands with traditional diversification rules. It's built for focused, sophisticated deal-making.
Well put. It aligns the structure with the strategy.
Now, for our final thought, let's circle back to that passporting issue. We established the SICAR vehicle doesn't have an EU product passport. Its marketability hinges on its manager, the AIFM, having a manager passport.
Right. The manager carries the passport, not the fund itself.
So here's something to think about. Does this dependence on the AIFM's passport make the choice of AIFM even more critical for a SICAR compared to, say, a UCI's fund, which does have its own product passport?
That's interesting. You're asking if the distribution strategy becomes disproportionately tied to the manager selection because the fund structure itself isn't the key to market access.
Exactly. How much more weight should you put on the AIFM's reach and regulatory status when the vehicle itself can't be directly passported? Something for you to mull over.
The great point indeed. The vehicle is one thing, getting it to investors is another.
And on that note, thank you for helping us dive deep into the Luxembourg SICAR today.
My pleasure. Always interesting to unpack these structures.